mentioned some of these benefits already. Like the core benefit, as we mentioned, is what Peter just mentioned is estate tax benefits. As these assets grow, they grow outside of your estate, so there's no estate tax benefits. Do you just want to give a quick overview of the tax-free growth benefit of insurance?
Yeah. So one of the reasons wealthy people use ILITs is because they allow you to take advantage of both the estate tax benefits of irrevocable trust and also the income tax benefits of life insurance in general. Life insurance, if you're not familiar, the investments inside of a life insurance policy aren't subject to income tax, state or federal. Basically, your pre-tax return is also your post-tax return. And the death benefit is also not taxable when you die. Depending on how the money's invested, you can potentially generate pretty strong returns post-tax
Yeah.
using life insurance.
Yeah. And this is where it's like one of the typically a trade-off with insurance is that you get lower growth, but it's tax-free growth. Now, there are exceptions to this, things like private placement life insurance. We won't get into that today. That's its own subject. But really what we're talking about is you get these two core benefits of tax-free growth from the insurance policy of the investments, plus so you're avoiding capital gains and income taxes. And then you're getting estate tax-free growth because that appreciation happens outside of your state. Is that right, Peter?
Yeah, exactly. Yeah.
Now let's get into the non-financial benefits. What are the other reasons that people use ILITs?
So there's a few other benefits. So setting aside the tax stuff. So irrevocable trusts in general provide a lot of asset protection. And so, if you were going to have a life insurance policy, you might want to own it inside of a trust, even without tax considerations, just to provide that extra layer of asset protection in case you have lawsuits or other issues, or your beneficiaries have creditors. That's one of the big reasons people set up.
But
ILITs are often used as a source of liquidity for families who have estate tax liability, because you know that when a person whose estate it is dies, right after they die, the insurance company is going to cut you a large check. And so that's sort of a guaranteed source of liquidity for estate taxes.
I thought it might be helpful to dive into this more, to those two particular things. Like, what are some, I think people tend to underestimate the asset protection benefit of ILITs and broadly asset protection, because this is one of those things of, I think the common scenarios this comes into play, and feel free to add on, Peter, are if people get a divorce. So you could set up a trust for your kid, and let's say they get a divorce or they're in a car accident, because first of all, obviously no one here wants those things to happen. Unfortunately, life does happen. Maybe do you want to kind of explain of how would the asset protection benefits benefit someone in those scenarios?
So there's a few different layers. One thing to keep in mind is it's not just protecting the insurance policy or proceeds from your creditors. It's also protecting the proceeds from ongoing investment returns from your kids' creditors or grandkids' creditors, whoever the beneficiaries are. And so typically with an ILIT, the way it's set up is set up as what's sometimes called a dynasty trust, a trust that's designed to last multiple generations. And so that does a few things. One of the things it does is it gets assets out of your kids' estates, which means both that the insurance proceeds and those investment returns won't be taxed on their deaths, and also that their creditors, including divorcing spouses or business partners who are suing them or whoever, won't be able to access those assets because they won't be personally owned by the beneficiaries themselves.
Yeah, that's a big piece. And then let's go to what are the trade-offs and downsides of ILIT. So I'll start with one that's not even on here. Whenever you set up entities or legal structures, there's typically a cost. There's typically an upfront cost and ongoing cost. Not to talk about Valor too much. One big difference between Valor is we don't charge anything for these trust agreements or trust documents. So there is no upfront cost. And then we tend to be fairly low in the administration costs, typically a percentage of others. But there is some added cost. Obviously, in doing this and getting these other benefits, there's a cost to doing so, accounting, legal filings, etc. But what are some of the other trade-offs, Peter?
Yeah, so there's a couple. One is, the trust is irrevocable. You actually can make changes to the trust agreement, certain limited changes depending on context. But in general, if you're putting $1 million into an ILIT to pay insurance premiums, you shouldn't count on getting that money back. You should think of it as like you're giving away that money, and it's going to be your kids' money or your grandkids' money. So it's, at least to some extent, a permanent transfer of wealth from you to someone else.
Yeah, and by the way, this is broadly true of most irrevocable trusts, not all. In most cases, you are giving away the money, and this is also where the benefit of getting the money outside of your estate, so the growth is estate tax free, in most cases precipitates that you no longer have access to it. So it is kind of the yin and the yang, and this is for folks who are worried about estate taxes. But you typically want to be financially secure. You don't want to be depending on this money for your own kind of ongoing financial needs.
Yeah. Yeah. And so that sort of relates to Brian's question. Can you borrow from or borrow against the assets inside the ILIT? And the answer is yes. You can borrow, you can't borrow against them, but you can borrow, you can borrow from the ILIT. It's a little bit complicated, more complicated than if the ILIT didn't exist, but it's definitely doable. So basically you can't borrow directly from the policy, but you can borrow from the trustee, and the trustee can borrow from the policy. So if you're planning on using a life insurance policy primarily as like an income replacement type vehicle, where it really makes a lot of sense is where you're really just trying to, you're setting up an insurance policy and you view it as a long-term wealth accumulation vehicle, and you want to transfer as much assets as possible to your kids. That's really the prototypical use case. And so in most cases, people aren't borrowing a ton from their ILITs, although it is possible.
Yeah. That's so yeah, and this is another way I'd frame this is you can if you really need to. It's not built to do that. So there's a couple of intermediate steps, and you shouldn't set up an ILIT with insurance in it with this in mind. But it's almost like in case of emergency, you could do that if needed.
Yeah.
Now we'll get into kind of one other basic question of what's the difference between an ILIT and an IUL? I guess well they actually work together. But do you
Yeah.
want to?
Go together. So an IUL is a type, it's Index Universal Life. It's a type of life insurance policy. And so the ILIT is the trust that owns the insurance policy. And so you could put an IUL or a VUL or any other sort of life insurance policy inside of an ILIT. And so the ILIT would be the owner and also the beneficiary of the IUL. But yeah, basically the difference is the ILIT is the sort of the structure, and the IUL is the policy.
Yeah. Yeah. In other words, they're complementary. And generally, ILITs are complementary with insurance. You will put insurance inside of an IUL. It's not a replacement for insurance. You can get insurance, not have an ILIT, but you wouldn't get an ILIT. You wouldn't set up an ILIT unless you had insurance.
Yeah. You'd be setting up an IDIT or some other type of trust if you didn't have any insurance.
Thank you.